Now, instead, I think the key risk is longer term inflation. Doesn't mean you can't temporarily get the inflation rate down, but it means that as long as these forces exist, the inflation rate's bias is up. And so unless it's actively being held down, it's ready to kind of keep popping up or kind of keep being a problem. And one way to think about it is kind of like how everything's a nested ledger, right? So we have accounts at banks, they have accounts at central banks, and central banks back up their assets with like government bonds.
In this episode, Lyn Alden, founder of Lyn Alden Investment Strategy, delves into her recent article on the Federal Reserve's financial situation titled "How the Fed Went Broke." She explains how the central bank is experiencing a loss for the first time in modern times and discusses the potential consequences, including ongoing high inflation, government agency bankruptcies, and implications for the Fed's independence. For the first time in modern history, the U.S. Federal Reserve is on the brink of having negative tangible equity, as it has been operating at a financial loss for several months. Lyn said that in a few months, the Federal Reserve will have lost enough money from this negative net interest income that it will have negative tangible equity. In other words, its financial liabilities will exceed its financial assets. Before proceeding further in this video, please make sure to click on the subscribe button below to stay updated with our latest content.
Central bank has assets, which, in the older days used to be, say, gold, for example. Now they're, often government bonds, mortgage-backed securities, other things like that. And then they have liabilities, which are the monetary base of that country. And so the United States, the Federal Reserve's monetary base, their liabilities, that's the monetary base of the country. That's basically base dollars. Like at the end of the day, that's what a dollar is. It's a direct liability of the Federal Reserve. And so you can have that in two primary forms. One is physical banknotes, right? If you hold physical cash, it's a direct liability of the Fed. And two, banks store their cash with the Fed in digital form. It's just an entry on the Fed's ledger, and that's a direct liability of the Fed. And so those two components make up the monetary base. And then what banks do is they essentially multiply it. So when you have a deposit at the bank, you have an IOU that is for $1, but they have way more IOUs than they have base cash, because they know that most people are not going to all redeem them at once or even try to. And so you basically have this fractional reserve system. And there's actually, I didn't go in this article, but then the third layer would be international, euro dollar system. Basically, you can have a foreign bank, they have a deposit at a domestic bank, and then they further fractionally reserve it for people that might be holding dollars with them. And so you have a series of fractional reserve IOUs built on fractional reserve IOUs that at the end of the day are a claim on the liability of the Fed, or in another case, if it was Bank of England, whatever the case may be, that liability side of the central bank is the monetary base of the country.
According to Lyn, throughout the year, the Federal Reserve had implemented an unusually rapid increase in interest rates, including on their own liabilities. However, the majority of their assets consist of long-duration instruments such as U.S. Treasuries and mortgage-backed securities, which are fixed rate and locked in at lower interest rates, without any upward adjustments. The U.S. Treasury had been receiving a substantial source of revenue from the Federal Reserve in the form of cumulative remittances, amounting to around $1 trillion between January 2011 and September 2022. However, these payments have now ceased, resulting in a loss of this revenue stream. Federal Reserve describes this issue as the Federal Reserve Banks remit residual net earnings to the U.S. Treasury after providing for the cost of operations, payment of dividends, and the amount necessary to maintain each Federal Reserve Bank's allotted surplus cap.
The Fed's kind of different than other central banks in that it's a public-private partnership. And so it's a little bit more complex. But at the end of the day, it's just kind of this semi-autonomous entity, but that is nonetheless overseen by the government. And so they, going back to the assets and liabilities, their main assets are treasuries and mortgage-backed securities. And their main liabilities are bank reserves and physical banknotes. And so for most of Fed history, their assets paid a higher interest rate than their liabilities. And so after covering their expenses, they earn tons of money, $100 billion, and then they give all that to the Treasury. And so in some sense, you can think of that as, the Treasury has to pay interest to the Fed because the Fed holds a lot of Treasury securities, but then all that money just goes right back to the Treasury. Basically, that almost like that portion of the debt is like zeroed out because any interest they pay on is essentially going right back to the Treasury.
Although inflation has been declining recently, there are still some underlying issues that remain unresolved, which could potentially lead to a resurgence of inflation in the coming years. Lyn suggests that periods of price inflation are typically temporary when considering the rate of change, but not when looking at the absolute level. This means that prices may not return to their previous levels, but the pace of their increase will slow down. Rather than going to the U.S. Treasury in the form of remittances, the money is now being directed towards the U.S. commercial banking system and money market funds. U.S. banks, money market funds, and similar entities consider the interest-bearing liabilities of the Federal Reserve as interest-bearing assets. Alden expects fiscal deficits in the United States to remain unresolved and to be long-term contributors to structural money supply growth and price inflation this decade, once we get past this current lull of tightening.
And what we're seeing now is that when all that is held up to the sovereign level, when you have all the debt goes up very high, the only place to kind of release it from there is onto the currency, right? So you get ongoing currency devaluation, ongoing off and on inflation, and ongoing periods of time where however high or low yields are, they're spending most of the time below the prevailing inflation rate, and therefore savers, bondholders, all these types of holders in the system are essentially getting devalued, and that's kind of just spreading out the losses to anyone who's involved in the currency. So I think that what's going to drive inflation over the next decade is a combination of uncontrolled fiscal deficits by most of the developed countries, and then two, unlike the past decade, there's not really like a buffer for commodities. So there's no real like commodity oversupply and deflationary commodity markets that can offset some of this. So you have the combination of money creation's happening because deficits are high. One way to think of it is that government deficits are a surplus for the private sector. So it's basically it's a way that money kind of pours into the system, and then when you also have tight commodity markets, that makes it so that those increases in money supply do translate into higher consumer prices pretty readily, and that's also true for things like labor shortages. Now you can have periods of time where if you get a recession, if they cause a big enough contraction in a period of time, you can get a temporary disinflation. You can get a temporary, contraction. You can reduce demand enough to maybe suppress prices for a period of time. But I think those are going to be, the cyclical things, whereas the structural thing is that inflation, unless, of course, they find a way to sharply reduce deficits, which is, at this stage of the crisis, very, very hard to do.
If the Federal Reserve's tangible equity turns negative at the end of this year, it would have negative net worth. This would be a significant concern as it could impair the Fed's ability to carry out its monetary policy and lender of last resort functions effectively. That's all about today's analysis. According to you, will Federal Reserve's tangible equity turns negative later in 2023? We invite you to share your thoughts in the comments section below. If you found this information helpful, please consider giving this video a thumbs up and subscribing to our channel. We look forward to bringing you more updates in the future.